to LuxVoyagEchoes. Today we delve into the fascinating world of equity investments with none other than Mr. Akhil Chaturvedi, Executive Director at Motilal Oswal AMC. Akhil, it's a pleasure to have you here. Let's start with the basics. What exactly is equity and how does it differ from other investment options?
So equities in simple thing is trying to buy a minority stake in a company which you like, where you feel that the growth prospects of the company will be good, right? So for example, you buy X company, 0.1% of that X company through equity. You're becoming a stakeholder or a shareholder of that company. And by the meaning of equity or becoming a shareholder of the company means that you're participating in the future growth and the future profits of the company, right? So equity in simple terms means buying a small stake in the company you like, right? So that's the basic about. Now when you compare equities where you're actually trying to participate into the future profits of the company, there are other asset classes like a fixed deposit. Now in a fixed deposit, you're buying of a particular bank. You're not really buying into the profits of the bank, but you're simply you're lending to a bank at a predetermined fixed interest rate, and you will get that fixed interest rate for the period of time you have invested your fixed deposit for. So it's very, very different in terms of what the outcomes will come from a fixed deposit or a fixed income kind of investment or equity. Now, since you're buying into equity, you are taking risk. You are taking risk on the future growth and the future profits of the company. Therefore, there is a possibility that you invest in the right company. There's a possibility you may not invest in the right company. There may be a possibility you invest in a company which grows slowly, therefore creates relatively lower returns, versus you are lucky and you invest in the right company where the returns could be very high. So the returns are not defined. It will vary from company to company. Whereas when you do a fixed deposit, your outcomes are determined, right? So you know that you're going to make your 6%, 7%, 8%. You really don't have to worry. So if you're trying to preserve your capital, a fixed deposit, fixed income is a good vehicle. If you're trying to create your wealth, you have to take higher risk, and therefore you have to invest in equities. In long term, we have seen that Indian companies, let's say, which are part of BSE Sensex or Nifty 50, over the last, let's say, 25 years or so, the top 50 companies or the top 100 companies have grown their profits anywhere between 13 and 15%. So those who have invested in the top 50 or 100 companies in the last 25 years would have participated in that, the growth of 13 to 15%, because that is what will reflect also into the price growth. Whereas on a similar way, 25 years back, you have bought a bond or a fixed deposit of 10%, you made your 10%, versus you made your 13 to 15% in your Nifty 50 or a BSE Sensex. So it's all about your risk profile. You want to make more returns, you have to take more risk, and the only hedge to risk is time. We've discussed this in the past, in the previous questions as well. This is a broad differentiation between these two large asset classes. The third asset class, one tends to invest. Almost everybody wants to buy their own home. So real estate, now you could say this is an investment, but I feel that when you're buying your own home, it's really not an investment, but it's a consumption, because you're not really earning anything out of that home. So neither do you get rent, and even if the price of that asset is growing up, you're not really going to sell your own home. So if you're buying a second home for investment, maybe then you can consider this as an investment. So real estate is your third asset class. And fourth, a very popular asset class is gold. So especially when you are in tough times and when there are natural calamities, there are unforeseen, not so great times, gold will come to your rescue. Very easy to liquidate. Returns may be slightly lower, but it's always a good protection in your portfolio.
Why do you think equity is such a crucial component of a diverse investment portfolio?
Because it is one asset class, which if you see the long data, let's say, you can go into almost 40 years plus of data, which comes from BSE Sensex. BSE Sensex started in 1979 with 100 points. right? And now over 40 years, the 100 points has grown to almost 85,000 at top, right? Today we are at 80,000. So that's a 800 times growth.
How can investors minimize risk while investing in equity?
So one way of minimizing your risk is to do the right allocation. Do only that much allocation which you can actually forego for a very, very long period of time. So if you have 100 rupees to invest, you need to decide how much of that 100 rupees you want to really invest in equities, which can be forgotten for at least a minimum of 10 years and then longer the possible. So do not over invest just because equities are doing well and they are giving phenomenal returns, because you may end up taking higher risk. So control your asset allocation and then be disciplined to maintain the allocation at all points of time. For example, if market goes down and your 20% allocation in equities goes down to 17%, you should increase your equity allocation when the valuations are down back to 20%. So what you're doing is you're buying when the markets are going down. Similarly, when your 20% goes to 40% because of the market growth, you can also do your profit booking and reallocate your portfolio into other asset classes. But be disciplined, decide an allocation and stick to it. Now the other ways or the other solutions which are available for all of you, especially by mutual funds, is basically the hybrid funds. Typically this category of funds, different managers are using different tools to identify the valuations of the equity. Right now, when the valuations of equity is getting high, the fund manager will tend to reduce the allocations into equity, and vice versa. If the valuations in equities are low, will actually allocate more towards equity. So we'll try to buy low and sell high at all points of time. It is done using various financial and valuation tools. So, right. The third way is actually you can get into a multi-asset fund kind of a category where you can buy into all asset classes. So you can buy into equities, let's say 40-50% equities, 25-30% debt, and then you can buy gold and you can buy silver. So these kind of products also are now available, because different years, different asset classes outperform each other, right? So by having a combination of all asset classes in your one portfolio, you are actually well taken care of for forever kind of stuff, right? So these are some now opportunities which are available depending on your risk appetite, whether you want to do your own asset allocation or whether you want to go with the fund manager. All kind of products are available for people to benefit from.
Speaking of markets, what are the current trend in equity and how are they shaping investment decisions?
So current trend in equity markets, we are in 2024. I think ever since we got out of COVID, the trend has been only positive for India. India has outperformed in terms of its growth cycle. So the GDP growth for India has been the highest. We are the fastest growing country. I think in the last 4-5 years, we have seen that the Indian companies are benefiting from the economic cycle. So Indian businesses have been growing their profits quite spectacularly, and that has resulted into the stock markets delivering superior returns. So we are in a positive market scenario. We are in a positive economic scenario, and this is likely to continue for next several years. If you go by any kind of a research report or any agencies who are coming out with their projections on how India will fare over for the decade. So we are very, very excited for equities. I think it's a good cycle for equities, especially for Indian equities, where your macroeconomics are in place, the earnings growth is looking very, very strong, and that would eventually result into compounding of wealth for investors, those who are allocating a part of their wealth into equities. Now this has resulted into influx of a lot of market participants. So we have seen that 5 years back there were just 2.5 crore investors investing in equity mutual funds. Today there are 5 crore investors who are investing in mutual funds. So that has doubled up. If you see the demat ownership, 3 years back there were just about 2.5 crore demat accounts. Today we have over 17 crore demat accounts, adding almost 40 lakh demats every month. Right, we have seen this SIP book go up almost 3 times in the last 5 years, from 7,000 crores to now 24,000 crores. So more and more investors are now coming into equities. More and more investors have benefited from the the great performance which has been delivered by Indian equities. And I think this good experience will ensure that the investors continue to remain invested and will continue to attract more and more Indians to invest into equities, and hopefully they come through mutual funds, because that is the best vehicle to participate.
That's interesting. Are there any upcoming trends you think investors should watch out for?
There are many trends. We are into a very good economic cycle in India. We are seeing that all kinds of themes, all kind of sectors are doing well, right? So you just go back 5 years, for the preceding 10 years, 15 year period, a lot of sectors were going through a lot of headwinds. The telecom sector was not doing well, the infrastructure sector was not doing well, power sector was not doing well, PSUs were not doing well, banking sector has been through a rough cycle. But now what you see in the last 4-5 years, that after all the reforms which have gone through in our country since 2014, all sectors are benefiting from growth. They are producing large pools of profit. So if you want to really participate into any thematic opportunity, so for example, if you feel that banking is a good opportunity for next 5 years, you can buy into pure banking financial services fund. If you like capital market businesses, there are variety of funds which are available, which can help you to invest into capital market growth story, or if you want to participate in the manufacturing growth story or the defense growth story. So there are so many opportunities today where India is offering a huge potential to create to benefit from these opportunities and create a lot of wealth. So I think those are some of the trends investors can look at. Alongside, I think there are new kind of products. So I think we spoke about this quant style of investing, which is using mathematical models, past data trends, and then creating a model for investing into a portfolio, creating a portfolio. I think this is a new emerging opportunity. Regulator is talking about a new asset class within the mutual funds, where you can create a PMS AIF kind of a portfolio under the mutual fund umbrella, which will make transacting and investing far more easier with a smaller ticket size of 10 lakh rupees. So I think we are in a cycle where there will be a lot of options, a lot of opportunities, new asset classes. What we are seeing, at least in the HNI, ultra HNI segment, family offices, a lot of demand for buying into unlisted funds, private equity funds, angel investing, real estate. So I think all asset classes are benefiting today. There is a problem of plenty, I would say. Therefore, consult your advisors, do the right allocation. Opportunities are there. Just try and identify the right opportunity for you and benefit from that.
Thank you, Akhil, for sharing your invaluable knowledge and guidance on investments. I'm confident that these episodes have provided clarity and insights to our listeners, addressing many of their doubts and questions. Stay connected, keep sharing your thoughts, and let us know your feedback. Until next time on LuxVoyagEchoes, happy investing and stay inspired.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.